Typically those last hurrah or melt-up rallies tend to be parabolic. That's why I call it a melt-up. It's not just an ordinary rally. It will be something parabolic, and you'll cover an awful lot of ground. You'll cover basically several years of returns or several years of ground in a matter of months.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is David Hunter, a 40-year veteran on Wall Street. Thank you so much for joining us today, David.
Yeah, hi Elijah, good to see you again.
All right, now the first topic I'd like to discuss today is many people are looking for a stock market crash. We've seen quite a pullback for the last year, down about 10, 20%, depending on the different indices you look at. And it seems like the mood right now is very bearish on Wall Street. Now, you are a contrarian, and you are saying that actually we're about to see the reversal and a melt up going forward. Why do you say that?
Yeah, this is certainly a controversial call at this point. Most everybody is bearish. Sentiment is actually at levels that we typically see at market bottoms and some major bottoms. I mean, we're at levels that really, in a lot of ways, equate to what we saw in March of 2009, what we saw in March of 2020, back at levels in Christmas Eve of 2018, back to 2016. So we're at levels where everybody shifted to one side of the boat, if you will, where everybody's bearish. And that means they've pretty much acted on their beliefs. And so everybody's positioned bearish as well as being bearish. And what happens often at that time is that you can get a shift back the other way. I actually think, obviously, the catalyst for people being bearish is all of the rhetoric coming out of the Fed in the last several months, telling us that they finally got religion about inflation, that they mean business in terms of tightening and trying to wring out inflation. They recognize that it is not transitory, that it's more than transitory, and that the only way they can influence is on the demand side. The supply chain issues and the supply side create a lot of the inflation because there were shortages, et cetera. But what the Fed can influence is the demand side of the equation. And the way you influence that is obviously hiking rates, winding out some of the money that has been created the last couple of years, and tightening. So that has spooked the market, that has spooked investors. There's been selling going on. We reached our highs in the market the end of the year, end of 2021, and basically we've been in correction mode ever since. We've had a couple false starts, but we're down at levels where I think sentiment is certainly there. And there are signs. This probably might be where I'm not alone, but I've been out there ahead of everybody else in terms of saying, the Fed's not going to be able to raise rates nearly as much as they're talking. There was talk of 7 hikes this year and maybe 7 next year. And what I've said is because of the fragility in the system, because of the leverage in the system, it doesn't take nearly the amount of tightening that it would normally to create that demand destruction they're looking for. And frankly, most of that tightening happened in the bond market in the first few months of the year, when you saw, the 2-year go up 250 basis points and the 10-year go up almost 200 basis points or 150, 200 basis points. Those are big moves in a short time coming from the low bases they came from. And they really did a lot of damage in terms of, creating problems for home buyers. Mortgage rates doubled, more than doubled. Retail sales are falling. Inventories are very high at the retailer level. And you just saw in the most recent housing report that inventories are at a 9-month level now, which is the highest they've been in the pandemic. We're back to levels before the pandemic started. Those are all signs that you have created the demand destruction. You have done with your policy enough to really say we're probably in recession now, and if we're not, we're darn close. So I know most forecasters out there are talking about recession. A few are saying next year, and a lot more are saying 2024. We're like I said, we're maybe in recession now, or darn close. So I think the Fed's starting, hopefully, to notice that maybe they have to take their foot off the brake a little bit. And certainly the market is noticing that. If you look at the bond market and interest rate expectations, they're starting to go the other way. So we've heard from the Fed that they fully intend to hike rates 50 basis points in June, another 50 in July, and then see where things stand then. You've had at least one or two voices in the Fed talk about a pause at that point, or soon after that. I think you're going to see in the next 2 months a lot of change at the Fed, both in their rhetoric and maybe in the pause. I wouldn't be surprised to see a pause after the June hike. I doubt that it comes before that, but I wouldn't be surprised. It could be that they go with another 50 in July because they're still way behind, 2-year rates. The overnight money is still, only 1.5%. And 2 years up at 2.5%. So they have room to hike if they want to. And it's pretty much in the market, so it's not a big deal whether they do or not. I think the thing to watch over the next month is how the rhetoric changes. If that jawboning starts backing off somewhere, they've really the other important part is that the Fed has clearly, and it started with an April speech from Bill Dudley, who was former New York Fed president, about basically the need to get the stock market down, because in the environment we're in now, wealth and stock market values make a lot of have a lot of impact in terms of overall financial conditions. And unless we get those valuations down and hit wealth, we're not going to have an impact on inflation to any real degree. I think Jay Powell took that to heart, said, I agree with you, Bill. And that's been the policy for the last, ever since that April talk, that they really, for a long time, it was always said the Fed had a market where they would come in whenever the market got weak, and investors kind of lived by that, saying, hey, I know the market's not going down that much because the Fed will come in. Well, now they're basically reversing that and saying, we want the market down. And so that spooked investors in the last month. I think all of that's going to, kind of go away in the next month as we see just how hard the economy has been hit. I can't stress enough. This is the Fed's MO every cycle. They don't understand leads and lags to their policy, so they enact policy to try to end the cycle or to have a soft landing, and it always ends up in a hard landing. And the reason for that is because they wait for the data to tell them whether they've gone far enough. The data is coming months after that, and unfortunately, by the time they recognize it, we're already in a hard landing. So they're doing it again. I think they've already engineered a hard landing. We're going to find that out over the next 6 months. And but initially, it's really the battle. The debate will be over: are we in recession or not? So for the summer, that's probably the debate. But as we go through the year and into next year, we're going to find out they went too far. In the meantime, this is the confusing part. In the meantime, as they see that they've already got a soft landing, maybe more on their hands, they're going to pivot. Now, pivot doesn't necessarily mean they go from QT to QE. Pivot doesn't necessarily mean they start cutting rates after telling us they're going to hike rates. Pivot might simply be, we hiked 50 basis points in June and we're going to pause. And if that comes as soon as June or after the July hike, I think that will certainly have people jumping in and saying, okay, Fed tightening's over. All our concerns about, them engineering something much worse start going away, and you will see that melt up. Now, what I have said is the market's not going to wait for the melt up. I mean, the market's not going to wait for the pivot, the Fed pivot. What will happen first is you'll see the market narrative or the street narrative reverse, and that's happening already. When you look at interest rate futures, et cetera, the structure of rates are showing that they're already beginning to reverse. That's what the market will see, because that leads the Fed. The Fed always comes in after. So everybody's thinking you have to wait for the Fed to change. No, the Fed will be slow to change. They'll be the ones that recognize it last. The ones that recognize it first are the markets. And so I think that's, as we speak, I think we're probably going to, I think we may have seen the lows on Friday. Obviously, trying to call the very short term like that is not a high probability forecast or anything, but I think the odds probably favor that we saw the lows Friday. Markets in sort of a reversal mode today. I would not be surprised if we started to come out of the correction and that we'll see a powerful leg up through the summer. So my call is that we'll see S&P 6,000 within 3 to 6 months. That sounds crazy. It's well over 50% from the lows of Friday. And the NASDAQ 20,000, that's, it's over 70%, I think, from the lows, maybe 80% from the lows. So those are unprecedented moves if they happen in the next, 3 to 6 months. But that's the environment we're in, is everybody made the decision to get on one side of the boat simply because of the Fed. And they will all be rushing to get to the other side of the boat at the same time. It's almost the reverse of yelling fire in a crowded theater where everybody has to get through the exit at once. This is the opposite. Everybody has to get repositioned into the equity market at once, or feels they have to. So I think you're going to have a very concentrated rally. Like I said, I don't know whether it's 3 months or 6 months or something in between, but something very concentrated. And I think it's the last hurrah. I think we are at the end of a 40-year secular bull market that began in August of 1982. I use that date because that's the beginning of the disinflationary cycle. We went from 15-20% inflation rates and started ratcheting down over several cycles. And that's what boosted PE multiples from single digits back in 82 to ultimately the mid-20s for a market multiple last year. So what I think here is that we're in the very last stages of a very long secular bull market. There were several cyclical bull markets within the secular, but we're in the very last stages of that. And typically those last hurrah or melt up rallies tend to be parabolic. That's why I call it a melt up. It's not just an ordinary rally. It will be something parabolic, and you'll cover an awful lot of ground. You'll cover basically several years of returns or several years of ground in a matter of months. That's not normal.
When it comes to inflation, it seems like a lot of people are expecting inflation to stay high for quite a while, but you're actually looking for inflation to dip. And I guess that could be a reason for the Fed to pivot.
Yeah, exactly. I think inflation has peaked. It's somewhat of a technical thing, comparisons year to year and prices, because prices were up a lot in the last year. As you move forward through the second half of this year, the comparisons allow you to say, hey, yes, inflation's up, but it's not up as much as it was. So part of it's technical, but there's also, when you look at other parts of the inflation equation, like commodity prices, You're seeing a lot of those that have rolled over. Lumber was $1,700, a board foot or whatever in the futures market 2 years ago. It's 600 and change today. And it was, it had risen back up into the 12 or 1300 area, not that many months ago, and now is back down. So you're seeing it in certainly lumber, which is a housing related, demand related thing. You've seen some other metals and other commodities come down. It doesn't mean your prices at the supermarket are come down, or that your price on clothes is going to come down, et cetera. That's not what inflation is. Not a price thing. It's the relative change in prices over a broad spectrum of goods and services. I think we're pretty close to the peak if we haven't seen the peak, and I actually think we have seen the peak. I don't know how fast it will come down, and frankly, I don't know that CPI is really the gauge you want to watch. It's a popular one because it gets released and everybody sees it. But there's the Fed watches the consumer deflator index, et cetera. I think we will see that we're going to roll over, and it's just the beginnings of that rollover will have an impact on market participants, I think, in a big way too. So, and by the way, like I said, we may be in recession already, and I think we will be this year. I think this recession morphs into something much worse as we go through next year. So I'm calling for a global bust, and have been for a long time, as how this cycle will end. The reason it turns from just an ordinary recession to something much worse is because we've got debt and derivative levels at levels never in history. I mean, we're off the charts in terms of 300 trillion in debt across the globe, and that's risen just in the pandemic from 250 trillion to 300 trillion. A 50 trillion jump in a couple of years is just a massive amount of debt. And derivatives are in the quadrillions in terms of notional value of derivatives. As I say, debt is the leverage on the economy, and derivatives are the leverage on the market. And what that does when you roll over and you're heading down in both the economy and the markets, what that does is exacerbate it in a big way. So I fully expect a huge financial crisis next year. This to be, the worst downturn economically in the post-World War II era. So I'm not a Pollyanna when I'm talking about this run in the stock market. It's not because I think things are, hunky-dory. It's because you have everybody positioned for something right now that's not going to happen right now, meaning more tightening. And I think so you get people running back. And then I think the Fed, if you get the market up to 6,000 and NASDAQ to 20,000, given that Powell has bought into Dudley's views on stock market and needing that being a sign of excess in terms of the financial side, you can only imagine that whatever pivot they do this summer, they're going to pivot back and say, whoops, maybe we pivoted too soon. We're going back to the tight side. So I think, it's not a straight line. It's a little convoluted, but I do think that's what you're going to see, is that ultimately it's not that this, cycle it's not that the bad news is all over and behind us once we rally. It's just that it's not straight from here. We're going to go to new highs, and then I'm calling for an 80% bear market from those highs. So I think people are just premature in thinking the bust is now. And that's the funny part, is the view that's really spooking people is that the Fed doesn't get the damage they're causing, and they're going to cause a global bust. When I started talking about a global bust several years ago, people thought I was nuts. And now that is the forecast that's driving the bears.
It's very interesting how, but at this point, it's not the bust yet, as you're mentioning. We still need to go through that melt up. I wanted to get your perspective on how you see precious metals then playing out through all of this, the melt up and then the crash after that.
Sure. There's been a long road to get here. They had a great run in 2020 coming out of the March 2020 lows, and thought maybe you'd have a few month consolidation of that run. And instead, it turned into a 18-month, 2-year run consolidation. And I think we are now out of that consolidation or coming out of that consolidation. They started to go earlier this year, and then unfortunately the rise in rates and a strong dollar kind of sidelined them again. But I think we are poised here. They are very critical inflection points where both gold and silver look like they're ready for big runs. I am forecasting, I raised my gold target back in my second quarter letter back in April. So I'm now looking for 3,000 on gold. I was looking for 2,500. So in spite of the frustration of how long it's taken to get here, I actually think the upside this cycle is bigger than it was. In silver, I'm still calling for $50, which is a big run from, it's down in the low 20s. And I think I'm probably going to have to raise that at some point. So, but for now, $50 is my target. I think they will pretty much run coincident with the stock market, with the melt up in the stock market. So I think, again, between now and the end of the year, you should see that run to those targets. And very simply, I think part of it is that the bond market is going to start to rally. Rates are going to start to come down. That will help gold and silver. I think their recognition that maybe the Fed is backing away from the extreme tightening that they were going to do will help. And, again, it's not a straight line from there for the next several years. I do think the bust is going to hit all assets except maybe treasuries. So there will be a correction after we have this big rally in gold and silver. They'll take a pretty good hit in the bust. And then beyond the bust, I think commodities in general are going to do very well, and precious metals especially well. So I'm calling for easily 10,000 on gold by the end of the decade, maybe 20,000. Silver, at least $400. So those are huge runs. If you can get to 50 or 60 in this side of the bust, go through a correction that can take you down 30, 40, 50%, and then a big run to the end of the decade. That's how I see it. And gold, same thing, run to 3,000, maybe you correct back to 2,000, and then run to 10,000, maybe 20.
And when it comes to the miners, how do you see those will perform?
Sure. Yeah, the miners should benefit greatly from the price moves in the metals. I think the miners pretty much mirrored the metals in terms of long consolidation after the August 2020 highs. They are also looking like they are at an important inflection point where they're going to start moving up. And I think you will see that sector of the stock market be among the top performers in the next 6 months.
All right. Well, David Hunter, it seems like it'll definitely be a wild ride ahead. Your any last thoughts before we let you go, and where can our viewers find you online?
Sure. I do want to just say the Treasury bond market, I think bonds in general have had a nice correction as the Fed tightened. And it looks like they are finding a bottom here, just like the stock market. I think the treasuries, if I'm right about this being a top in rates for the cycle, and then a bust coming late this year, early next, or through next year, the treasury long bond, which is got up to 3.25%, can probably drop to 1.5% next year. So, and it won't be a straight line. There'll be ups and downs, but I think you're at the highs in rates, or were recently. 10-year, I think, which got up to 316, I think was a high water mark a couple weeks ago. I think that can go all the way down to zero. We may even see negative rates on the 10-year in the midst of the bust. So over the course of the next, say, 12 months, the treasury market will be a place where you'll see lots of appreciation in the bonds. Corporates, not quite the same. Corporates, the lower quality, the junk and lower investment quality will get hit in the bust. They will not be appreciating in the bust like treasuries are, but they could rally certainly here during the next several months as the Fed backs off its tightening. So I think just because bonds, I think, are going to play a pretty big role here, I didn't want to leave that out. People can find me on Twitter. My handle is @DaveH_Contrarian. And I'm on there most days. Lots of people take an issue with my calls because they are so controversial. So a lot of activity there. And then I also have an investment letter that if people are interested, they can direct message me on Twitter. There's a subscription cost to it. But if people want details, just direct message me on Twitter.
Fantastic. David, once again, thank you so much for your time and God bless.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.